Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in there, take a look, see what people are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, we have a Sunday question and answer session coming up at 5 p.m. Mountain Time. You can ask whatever questions there. You can follow along with other people's questions. We do go over a wide array of things that you guys want to know about. We do have a special going on. Special is the coupon code if you'd like to join. 50% off the first month only, and a larger discount on the yearly membership if you'd like to directly sign up or swap from the monthly membership. So from Not Jerome Powell, he says, can someone explain how you make a trade war with every country on planet Earth and expect that you'll win? So Trump put tariffs in place, and here's the confusing part. Is he doing this just to negotiate? Is he doing this to hit the stock market? Or maybe not the stock market, but really to hit the bond market and try to get yields down. He's trying to direct flow of volume of buyers into the bond market. I don't know how successful he'll be. I don't see a ton of people running out and going and buying 10-year or 30-year bonds because of the situation that we are in. So the situation we are in is we have a debt problem. We have a lot of debt that's rolling over, something on the lines of around $9 trillion this year. And a lot of it is rolling over in the first half of 2025. So the way that he is trying to drive demand towards bonds is to shock the system. He's trying to shock the system with uncertainty. He threw out a bunch of tariffs against everyone. Obviously, you wouldn't do that unless you wanted to shock the system. So he's shocking the system, trying to get demand to roll into bonds. And maybe he puts us into a recession. See, the tough part here is it's up to one person. He's literally trying to control the market himself, which we can look at the charts, we can do all this stuff, but and we can see when buyers buy and sell, but it really depends on one person almost and how long this stays in place. If he removes it, there's a lot of uncertainty around all of this. And that's why the market is having such a fit. I don't think he really told anyone before this, because if you look at the charts beforehand, there wasn't a ton of positioning in certain things. Yes, I think there's probably some insiders like maybe Buffett, Bezos, Zuckerberg, the CEO of NVIDIA, like some of those guys, you can tell they all exited kind of some months ago. So maybe they knew of something that was coming, but they didn't know exactly, maybe they didn't know exactly what it was or something along the lines of that. But right now, it's difficult to kind of gauge how this all goes down because one person put this in place, and they could lift it, they could change it, they could do whatever they want, and that uncertainty, I think, is really driving the markets here. This guy posted this. It says Smoot-Hawley tariff, which occurred here, and it's got Liberation Day. And he's comparing it to 1930 to 1931. This is 25 to 26. There's a huge difference between 30 and 31 and 25 and 26. And I think it's worth talking about. In the mid-1920s, going into the late 1920s, depending on where you were in the nation, we had a large housing market bubble. And that bubble was fueled by loans that were given in place just like 2002 to 2008, we'll call it. There was a lot of reckless bank lending. That all popped in the late 1920s. The stock market and the money that was created from the commercial bank loaning had momentum where it carried it into the late 1920s, 29. The stock market cracked and everything rolled over. A lot of that is a deleveraging or deflationary move in the 1930 and 31. So I don't know if the Smoot-Hawley tariff is something that you could attribute to that. The underlying weakness was all in the banking system, and they literally had deflation. Loans were going bust all over the place. I do not think that 2025 or 2026, whatever we've got here, that Liberation Day, I don't think it's the same market conditions. You could argue that the tariffs are more aggressive, and maybe we do get a recession. I don't think it's going to be like 30 and 31 because that was a true deleveraging event. That was like 2008. The housing market peaked in 2005, 2006, in that range. We had a ton of inventory coming online. Foreclosures were skyrocketing. There were a lot of data that occurred in mid-2000s, just like the 1920s, that we do not have today. At least we're not nearly as advanced or as far into the cycle as that. If you go look at home builders, something like XHB, so home builders are starting to put in a bottom here where we could eventually see a move higher. Now, the 2-day blip down here, this is a pretty difficult thing. This is a downtrend line break with a bullish engulfing. I would have easily said this is going higher. We had 2 down days here. You can see them down here getting ripped lower. That was from the tariffs being applied, the Liberation Day, so to speak. I don't think people saw this coming because you wouldn't have gotten this big move higher the day before. So I think it caught people off guard, and they must have either decided really late to do it in the way that they did. That might have been the case. And then they just said to everyone beforehand, hey, maybe something's coming, but we're not going to tell you what it is. But this is usually the first to respond would be higher. If we're in the middle of a housing real estate expansion phase, if we are going up and expanding in real estate and this bottoms and turns higher, I don't think the tariffs are going to be that big of a deal if that occurs. That is a major portion of the economy. So what we did is we had a shock to the system, but that shock to the system is in the middle of a recovery to an expansion phase. So we're in the strongest part of the cycle where things will go up if interest rates were to come back down. So I think what he's trying to do is he's trying to get away from all the fiscal deficit spending, and maybe he gets away from it, maybe he doesn't. I don't know, because they're still spending like heck. And then commercial bank lending will kick back up. The economy will kick back up if interest rates fall, specifically the 10-year, and we would see home builders make that bounce. It was looking good before he announced the tariffs, but yeah, the tariffs have definitely hit us to the downside. That is for sure. So I don't think this is right. What you would see in that type of environment, we're going to go back to, we'll do Lennar. They've got Lennar Corporation has a lot of, see how this is bottoming? It's up 3.5%. Not a big move lower. This was your head shoulder peak, and then the move lower. The peak was in 2005. We broke out in 2007 for a move lower. I do not think that this pullback is the same. I think that this is going to go up. We've broken, here we'll put on logarithmic for long term. Whenever we break these big long-term sideways action moves, we generally have a big run. I think we're going to be in a big run for a while, and that is the cycle. So although a lot of people are scared, a lot of people are anxious and frustrated with these tariffs coming in, and the market's selling off, I think some of it is normal. I do think that there is risk in the overvalued sectors, but this still looks good to me. I don't think this is peaking, and I think we'll eventually work our way on up for home builders over time. That's my estimation of the big long-term cycle. So it's not the same. 1930, I mean, it was done. 2007 was done here. It was a big break lower for that. No doubt that we've gone through a slowdown. There's no doubt that we've gone through a slowdown, but I don't think the homes have been built to get into a hypersupply phase, at least not yet. Could we grind out inventories higher over time? It's possible, but we would see the inventory levels. So haven't seen this since during the COVID crash, extreme fear at 4. That's what markets do. They can get fearful at times. And it's generally a good time to buy into the fear, which is extremely difficult for people. Even myself, it's extremely difficult to buy into the fear and try to buy the bottoms. I'm getting a lot better at it over time. And yeah, we're extreme fear. Now the question is, when is it going to bounce? When are we going to go higher? Is Trump going to keep these tariffs on? That's the hardest part. If it's let's say it's something else like C19. If it's C19, it comes through, you see a bottom, and then you buy the bottom and it comes back up. But the market conditions are pretty much stable during that condition. They printed money too, which is pretty easy. It's an easier read if they print a bunch of money and do a bunch of stimulus and lower rates and do all that. I'm not sure if that's going to come or not. It all depends on what Trump and Powell and these guys are like dueling it off at each other. I don't know what's going to give here. I don't know if Powell's going to lower rates. I don't know if Trump's going to peel back the tariffs. I mean, this is a pretty much 100% managed market at this point. We had managed markets, but this is like, it's pretty over the top here. It says when you lose a fortune because of your stock picks suck versus losing a fortune because the market plummets are two very different things. It says chill, people. And yeah, everything's been getting sold off. Obviously, we've seen oil get hit pretty hard. A lot of commodity sectors have gotten hit pretty hard. Other sectors fared pretty well, like home builders, for example. With the interest rates dropping, mortgage rates have dropped quite a bit. And home builders have been actually a pretty good spot to be watching. That doesn't occur in a deflationary scare. A deflation is generally a deleveraging event. Deleveraging means that loans are going bust. Home builders don't go up in a deleveraging event, for the most part. Is there fear? Is there uncertainty in the market? Most definitely. The thing that I want to gauge, or the thing that you want to gauge, is the market the problem, or is an external factor the problem? If the market isn't as bad as what people think, and this was applied to a market that, let's say, is not that bad, and you apply these tariffs, then it's just extreme fear and uncertainty. Once they're lifted, or if they're lifted, or maybe they don't, maybe they're not lifted. That's the uncertainty of all this. The market would still be strong underneath. If people think that there's all this weakness in the market, and maybe these tariffs breed weakness if they stay applied, and that's, again, the uncertainty. So a lot of people are fearful because you see this go into action, and you don't know if it's going to remain or not. 4 to 6 trillion destroyed from the stock market to save a few $1 billion through tariffs. Well, I think it's going to be like 400 or 500 billion in interest payments is probably what they're going after. Maybe not the tariffs themselves. So that's what they're I guess balancing. They're balancing destroying a lot of wealth from people versus rolling over that debt at much higher interest rates. I'm sure each percentage point is a pretty big outcome for billions of dollars, and that's what I think they're trying to do. It's a pretty realistic bet that the all-time top is already in for U.S. oil production. It will be obvious in hindsight, and the top in U.S. oil production has already occurred. It was in 2018. was the world oil production peak for just oil. They've actually changed their measuring. They're including natural gas liquids and all these other liquids in with it. So that is what's going to peak next, is the oil plus natural gas liquids. I also think that this is one of the reasons that we have a problem. The entire world, I think, is heading into an energy crisis. And I don't think people understand the ramifications of it. Some of those ramifications will have problems with debt. We could create debt crisis. We could create problems with currencies. All of those are tertiary problems to the inability to increase energy in a system. Homebuilders XHB, probably one of the first groups to bottom. Early leaders in the last bull market. They bottomed in June of 2022, well ahead of indices. One of the first major groups to roll over ahead of most recent top. Highly rate economic sensitive group. 2, it can sniff out changes in sentiment, Fed policy before we see it in other places. It's not really sniffing out, it's just insider information. So insiders get to buy all this stuff and front run all of the retail groups, unfortunately. Investment Wisdom says, I love volatility. Human nature hasn't changed a lot in 25,000 years. Some event will come out of left field and the market will go down. Volatility will occur. That presents a great opportunity. And that's what I would say, from Peter Lynch. That's a perfect quote to apply to today. The only thing that I will say is, will this event that came out of left field, the tariffs, will it stay or will it stick or will it go away? I don't know. And that's the uncertainty. Tariffs are Trump's current ego trip, says Christine. He looks at the sell-off and sees his power. Then when he extends the deadline or softens the tariffs, his ego gets fed again by the rally. I don't know if it's ego-driven. I don't know if this is a plan to lower interest rates and try to restructure the debt from, say, treasury bills to the longer end of the curve. Maybe that's what they're trying to do. Difficult to say, and I don't know how long this will stick. I mean, they're going to have to, I guess, work with a lot of debt. The problem is there's going to be a lot of jobs that get lost as we go through this. So balancing this out, I don't know if it's worth doing what he's doing. It's a difficult call. Do you just destroy your currency? Is it not time yet for them to destroy the currency? There's been people talking about central bank digital currencies that they're going to try to funnel us into, but they need to inject a lot of fear in the market for us to accept it. I don't want a central bank digital currency. I don't want any of that stuff. Not saying that I want the current system either. I'd like to go back to what the Constitution says of gold and silver as being money, and that's what I would like to do. But I don't want a central bank digital currency system because I don't want to be controlled, monitored. I don't want everything to be tracked. I think that's way over the top. I just don't want that. For sure, I felt like the COVID low was easier to see coming. Was able to hang in 50% cash and go all in right at the bottom. Ended up 70% cash actually because my gold and silver stocks imploded during the meltdown, but it was glorious rally out. This time it's trickier because Trump is causing the drop, and I expect he will decide to take his foot off the market's neck when he and his dark money backers are good and ready, positioned for the rally. So much money to be made if you're able to trade on this with insider information, which I expect many will have. He's completely right. And, I've been thinking about this over the past day or two. I'm like, well, how the heck do we know if the bottom is actually in? I mean, it's like one person kind of running this whole mix here. We can see positioning in the markets. We can see that with technical analysis. That's one thing that we can use to our advantage. But that doesn't mean that he can't change his approach. And the uncertainty here is huge. He could raise tariffs. They could get into tariff wars. They could get into all these different things that are kind of unforeseen. So We can look at the valuations. There's a lot of things that are really cheap right now across the board in commodities all over the place. But again, he does have his foot on the neck of the market, and it's like, how do we know it's done from that perspective? And there's a million things that he can do to shift it and change it and do all these different things. So yeah, he's completely right. Kevin's completely right here, and this is one of the things that I'm looking at this like, man, this is a difficult call. Peter Schiff says, let me see if I've got this right here. Here is Trump's brilliant plan: announce reckless tariffs to deliberately crash the stock market and send the economy into a recession. This will result in lower oil prices and bond yields, allowing the Fed to cut rates. What could go wrong? I think that's kind of what he's doing, pretty much. That's what I speculated. I did a video a couple weeks back on Besant talking about lower yields on engineering a crash. I didn't think he would do this. I was not prepared for this extent. I thought that they were going to crash yields, not crash everything. I didn't think that they were going to do that. Now, usually what happens is if they're going to crash the markets, they tell all their buddies, and their buddies all position in certain assets before that occurs. And you can look at Bezos, you can look at Zuckerberg, you can look at all these guys who sold stock earlier, but I don't think they knew exactly maybe what was coming. They just said, you know what, it's getting expensive. We're going to try to take this thing down, and maybe the Fed's not going to support the market as much, and they kind of turn and move it. I did not expect this to be like a shock to the system where they tariff everyone in 1 second, like in one flat go, and try to do it this way. The problem is doing it this way, and this is the reason I didn't think they were going to do it, is that it grossly reduces taxable income doing this. So I don't know if they're going to keep this out there because they need the tax revenue from higher stock prices. That's how, if you look back, we had the big bubble in 99, 2000, 98 coming up for the tech bubble. That is how, what's his name? Bill, oh my God, I can't remember the Monica Lewinsky, the president. Oh my God, I can't think of his name right now. Anyway, that president back then, you guys can put his name in the comment section. I can't think of it at the moment. I'm sure it'll pop in my head later. He ran a budget surplus based off of the NASDAQ bubble and all of the revenue that was being generated from the stock market and those profits. I can't imagine what's going to happen here, because you're going to save on interest if they can sell the debt on the 10-year, but you're going to implode revenues in the short term doing it with his strategy. So I'm in the camp that he's probably not going to hold this on for long. But again, that's just a total guess. I don't actually know. Market events stress test existing relative relationships. Development in global trade has not been changed capital flows to gold from other assets. Current issues may exacerbate a move that has been underway for months, but is still relatively early stage. This is gold versus Equal 8 SPX. The reason gold is outperforming is obviously the fear in the market. Gold is a safe haven asset. It falls less than other assets, and it goes up during fear events. So sometimes it goes up, sometimes it goes down, but it goes down less than everything else, and then the ratio blows to the upside. This is the beginning turn of a shift from financial assets to hard assets. It's all happening in front of our eyes. We're going through it right this second. And obviously everything is selling off for these past 2 days. So these could be great opportunities to add to the portfolio. The only thing that makes me unsure or uncertain is he going to lift the tariffs? Is he going to keep them on? What's he going to do there? And that uncertainty is really the big problem there. It's that uncertainty. Coming on down, Peter Schiff says, what's happening in the stock market is an example of what happens when you throw a match into a powder keg. Not only was the market one of the most overvalued in history, but it was priced for absolute perfection. A massive tax hike, a trade war, and a recession hardly qualify. I also think, I don't know if Peter knows the cycle. I used to follow Peter even back in the mid 2000s. I don't think he uses the real estate cycle to watch anything. But I think we're in that transition period between financial assets and hard assets. You can see it in a lot of the ratios. Right now, everything's getting dragged lower with these massive tax hikes against everything in all these different countries from tariffs. So nothing like a good old oil futures liquidation run in the middle of the night. Yeah, did you guys see that in crude oil? Look at what they're doing in crude oil here, which is kind of crazy. I'm going to go to really short term. The dark sections are the day, and then this is the aftermarket. So the shaded regions here are the aftermarket areas. All of the move lower in oil was done in aftermarket. And then when it opened, it stabilized and go higher for the day. So they hit this in the after hours. This reeks of manipulation. Same with silver. Go look at the silver. They just slam this thing hard in after hours too. These past 2 days, they do not want this to break 35. You can see we're up around 35 here, trying to break out, and then we got a massive slam, massive slam in silver. Now, is the silver squeeze done? No, not by any means. I think that silver is going to go way up, and this is just a temporary detour manufactured by Trump and Vicente, and they took it and hit all of these commodities: platinum, palladium, silver. They hit gold. They're trying to slow the move. They hit oil, and wherever they hit, especially in these aftermarket hours, that's probably where you want to be. All those areas. I think a big inflationary problem it will be coming. Everything is still out there in terms of the fundamentals. It's all still out there fundamentally for them to have problems, for us to go through a large inflationary move. Now, the question then becomes what he has done the past 2 days and going forward, what that looks like. That's the uncertainty. And he's injected a whole bunch of it. The time to get excited about silver is when the gold to silver ratio is above 100. Could it go to 110? Sure, factor that into your strategy. This market panic is extreme in velocity and will crescendo quickly. Silver drastically outperforms out of market bottoms. I think silver looks really good. And the ratio, if you guys want to see the ratio, GC over SI, the ratio is at 103. I think this is a great time to be looking for silver. Silver's, what is it? Low 30s up. I don't even know what it is anymore. It's been moving so fast. It's 29.65. This is a pretty good damn price for a potential entry point with the ratio that high. Now, could it go lower? Could we go back down maybe to 25 or 26? It's totally possible that we could get down there. And maybe we get a bounce and a rollover, something like that, before going higher. But the ratio suggests that we are drastically underpriced, and that usually is a great time to buy. It's like buying in 2020 at that bottom. Sometimes they raise the premiums. If the premiums are really low and the price is down here, I think that's a good spot to be looking between, say, $29 and $26 an ounce. It's a pretty good bet. Now, buying bottoms is extremely difficult. I don't know if this is a bottom. And we have broken out of this rising wedge, which means maybe we do get down here. If we get down here, that's a really good entry point. Really, really good from a technical analysis point. A breakout and then a retest. 24 to 26 would be that range if it gets down there. Once again, I ask, who will buy our bonds? I was informed that no rational person would purchase the 10-year yield at 5% because we are a broke country. It must go much higher. And then it's going down, is what he's saying. I think the trend is higher, though. So in the short term, we've got selling pressure, I should say. We've got lower interest rates, buying pressure in bonds, dropping the yield. But in the long term, people don't want our debt. It's going to go up in the long term. Win bottom, I'd like to see an inverse ETF volume, dumb money indicator surge to 50% before calling a potential bottom. He's saying it's up here. After yesterday's update, this number hit 43%. Not enough retail panic yet, in his opinion. And this was shared before the market closed. Just an FYI. It says tariffs are dumb. We're not going back to making toasters in Toledo. But if they crush yields and we refinance 30 trillion of debt just 100 bips cheaper, that's 300 billion plus a year in savings. Corporates have largely extended their debt maturity profile, and maybe it's time for Basent to do the same. Stocks, they can be juiced anytime with the surprise cut of QE. So maybe it's not totally dumb. How am I wrong? Well, you're not wrong that they could save money if they refinance. But I also don't think it is ethical to kind of do what he's doing to some degree. You're basically just bombing the market when you want to. And I'm sure some insiders are doing something here, making a boatload of money on this. So I don't think that's necessarily ethically right to do that. That's me. The Secretary of Treasury arguing that by putting us into a preemptive recession now, we are avoiding the next 2008. I cannot believe the stupidity. I really cannot. See, this is where things get a little bit dicey. I mean, they're doing this on purpose. They're like coming out and they're like, hey, we're gonna tank this thing. I don't know if that's ethical. I think what's ethical is to create a system that is fair and just and cannot be manipulated or taken advantage of. That's what I think. But right, wrong, or indifferent is what it is. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We've got that question and answer session at 5 p.m. Sunday, Mountain Time. And that special coupon code if you'd like to join. But that's all I've got for today. We'll catch you next time. This is Finding Value.